team that's building great businesses. And by the way, it's not always straight up and to the right. Many times we go through all sorts of challenges, and these entrepreneurs go through all sorts of challenges, but that's part of the fun of being on that journey. And so I'm continuing to really enjoy that work, and I want to continue to do more of it. I want to focus on even deepening those relationships and being more present for the entrepreneurs that I work with.
Welcome to the Leadership and Legacy podcast, where we interview inspiring CEOs, entrepreneurs, and software leaders who are building remarkable companies and legacies in the world. I'm your host, Austin Yoder, founder of Nagrathea Partners, an entrepreneurial investment firm dedicated to acquiring and growing one great founder-owned software company. As part of my journey, I'm learning from inspiring leaders and builders and gathering the most valuable insights and advice I learn along the way here with you, my wonderful audience, so that we can learn and lead better together. Thank you so much for joining me, and I hope that you'll find as much value and insight in the show as I do. Welcome back to the Leadership and Legacy podcast. Today is a very special episode. We have the deep honor of being joined by Doug Tudor. Full disclosure, I am incredibly fortunate to have Doug as a longtime friend, mentor, and as one of my investors. There are many for whom Doug needs no introduction, but for anybody who may not have the fortune to be acquainted with Doug yet, Doug has a very distinguished operating career and investing career. He has been an operating entrepreneur and a serial investor across many different styles of investing. Doug spent 9 years as a senior executive at a company called Asurion, which is the leading global provider of technology protection services for mobile devices. During Doug's tenure, Asurion grew from $225 million in revenue to $4.8 billion. Not too shabby. Prior to his time at Asurion, Doug raised a search fund and was the co-founder and president of Clear Creek Environmental. Doug studied history at Brown University, something that maybe not everybody knows. He's a history buff. He did his MBA at Stanford GSB. I have one fun personal question for Doug in just a moment. However, I want to preface this conversation and say we're going to be exploring different styles of entrepreneurship and investing today, including venture-backed entrepreneurship, private equity-backed entrepreneurship, and also search funds. And I am a search fund entrepreneur. Doug is a serial search fund investor and former search entrepreneur himself. I just want to preface the conversation and say that the goal of this recording and interview is very much not to be a commercial for ourselves. We acknowledge that we may have a bias towards search as people in the search community, but we're going to try and be as objective and data-driven as we can as we go through the conversation. So anyway, listeners can calibrate accordingly. And Doug, before we dive in, first of all, thank you for your time. And I understand that you are a very passionate fly fisherman. And I was curious, Doug, if you could share with us what may be one of your favorite fish you've ever caught.
Austin, great to be with you, and thanks for that nice introduction. I do love fly fishing, and it's one of my favorite fish. That's like trying to pick your favorite child. I once caught a huge rainbow trout up in Alaska that was 32 inches long and just a beautiful fish. And I'll remember that most of the rest of my life, that's for sure.
That sounds like a monster.
Yeah,
awesome.
Big fish, for sure. Yeah. Great to be with you.
Fantastic. So let's dive in and help our listeners set the stage here, Doug. You have been on all sides of the table, entrepreneur, operator, investor. You are a mentor and a coach and a board member for many in our community. I was hoping you could share a little bit of context with us on the types of roles and companies that you have been involved with, just so that everybody has the right context in their mind.
I had a 20-year operating career, and then 13 years ago, I switched to become a full-time investor. In my 20-year operating career, I had a variety of different roles. First, prior to business school, I worked in sales and sales management in the media business. Then after business school, I decided to do a search fund. I was lucky enough to have a dad who was an entrepreneur who actually did kind of what was a mid-career search. He didn't call it that, but he left a corporate job and went out and found a small business to buy with a partner. And so I saw that as I grew up and was really drawn to his experience. And so when I came out of business school, I decided to do a search fund. When my partner and I, Nick Mansour, we acquired and built a septic service business called Clear Creek Environmental, and we ran that business for a couple of years, and that was a great experience. After that experience, I was fortunate enough to join Asurion, as you mentioned, and I knew those folks because they were search fund entrepreneurs. Jim and Kevin had been mentors to me, and I had close relationships with them, and that business was growing like a rocket ship with a great team and a similar group of investors, and so I ended up joining them and worked there for 9 years and had an incredible experience at an amazing company. During that time, I had several roles. One, I ran M&A and corporate development. Then we bought a $100 million revenue warranty administrator, and I essentially did a corporately funded search. I went and ran that business as a standalone subsidiary. I was the president of that business. And after that, I was an executive in sales and marketing for the company. During that time period at Assuring, I started investing in search funds and really enjoyed the process of partnering with entrepreneurs and building businesses, and decided to ultimately become a full-time investor upon my departure from Assuring.
And so you've been professionally on the investing side for some time now. And part of the reason we're having this conversation today is to explore the differences between VC, PE, and search. I know that you have extensive investing experience across all of those models, Doug. I'd be curious, ballpark, how many investments have you made kind of through venture, through PE, and across search?
In the last 13 years, I've made approximately 100 operating company investments. I've invested in 100 search funds and 65 search fund acquisitions. I've invested in about 25 private equity-backed investments. And really many times those private equity investments often look like search fund type businesses. They're both buyouts and growth capital, those investments. And then I've invested in about, just because I live in Silicon Valley and in the Bay Area, it's hard not to invest in startups sometimes. I've invested in about 10 venture-backed startups.
Really helpful as context to set the stage. And so across all of these different investments, Doug, roughly how many first-time CEOs have you worked with?
Well over 100 first-time CEOs. And I've been fortunate enough to mentor search CEOs and private equity-backed CEOs, and also just develop a lot of relationships with entrepreneurs who are trying to do interesting things. And so the great thing about young entrepreneurs, or all entrepreneurs, is often they're open to partnering with other people and always looking for the best idea. So it's been a great experience to partner with a lot of different types of CEOs.
Fantastic. And roughly how many boards have you served on
13
over this
boards.
time, Doug?
Many of them have been quite long term. Quite a few of them are 7 to 10 years.
That's amazing. And so to play that back to you, I know that you have many different roles and responsibilities across the spectrum of investing, but you have been on the operating side. You are an individual investor through Ravenscourt. I believe you are also an LP and several funds. You've been a board member across many companies. So you really have seen VC, PE, and search truly from all sides, from all angles, kind of the full kaleidoscope of experience.
I have, and it's been interesting being here in the Bay Area. There are a lot of venture capital firms here, obviously. There are a lot of private equity funds here. And I've been in the search community now for 27 years. So I've seen the search community develop. I've seen literally hundreds of search funds and the incredible growth in the search fund community. And then I have quite a few peers that are working these various venture and private equity funds as well. So I've gotten the chance to view into all these different types of investing approaches, and I've learned quite a bit about them. And it's actually fascinating to think about how they compare and contrast. The United States is unique. We have such an advanced and incredible economy here, and we have so much different types of capital out there that invest in companies and businesses and all different sorts of stages. They have different types of positives and negatives that they're bringing to the table for entrepreneurs and owners. And so it's a fascinating place in which to be seeking capital. There are lots of alternatives.
So great. Doug, given your extensive experience across the spectrum here, I'd be curious, at the highest level, how would you help us understand the difference between VC, PE, and search?
So this is an interesting discussion. When you think about venture capital, first you should recognize that it's a multi-billion-dollar industry with hundreds of different types of firms. Typically, venture is best for early-stage, risky businesses. Oftentimes, venture is financing literally the person in the garage with an idea, a pre-revenue company, often pre-product market fit. There are many different types of venture capital, ranging from pre-seed to early stage to mid-stage and late stage even. But most venture capital investors are taking small to medium-sized stakes in very early stage companies, and they're hoping that those are going to turn into big winners. So some of the important things to consider about venture capital is that successful venture capital firms might have 1 out of 10 companies in their portfolio become a big success. And often those companies can become remarkable successes. Companies we know, Google, Facebook, Uber, companies like that. Interestingly, though, as well, 9 out of 10 of the companies they're backing often don't become successes. So it's definitely a high stakes game in the venture capital business. Most VCs are focused on investing in technology and biotech industries, although they do invest in other sorts of businesses as well. And they typically expect to invest more money in the company over time if the company continues to do well. There's lots of pressure to achieve very aggressive growth targets in these businesses because venture investors are expecting these businesses to hit it big. So one other important consideration is venture investors may or may not bring in different management over time to run the business as it scales. So they might back a founder, but then over time, they might change out the management team because it's necessary as the business heads into different stages of growth. So that's how I might generalize about venture. When you think about private equity, the way I think about it is private equity is kind of just upstream from venture capital. Although you could argue that the mid and late stage of venture capital and the late stage of private equity actually overlap. So you do see some private equity tech investors and some venture tech investors that are often competing in the same sorts of deals. But private equity typically is best for established, growing, and profitable businesses. There are many different types of private equity, just like venture capital, ranging from early stage growth capital investors to late stage buyout firms, and even firms that will take public companies private. They invest in profitable growing companies and often use debt in the capital structure of their investments as well. They invest in many different aspects and elements of the economy, and so private equity is present in many different parts of the economy where more often you see venture capital in the tech-oriented areas. And then finally, search, which you and I know so well. I view search as best for businesses in the lower middle market, for businesses with $5 to $25 million of revenue. Search investors and entrepreneurs always bring a new CEO to the table. So there's typically a built-in change in control as a part of taking on an investment or selling your company to a search investor. And by virtue of its majority operating model, search funds are partnerships backing a talented entrepreneur. So typically, venture is very early stage, private equity later stage, and search often looking in the very early stages of the private equity market.
That's really helpful. And Doug, from your experience, what would you see as the key pros and cons for each?
I'd start just by what you were saying earlier, since obviously we're not doing a commercial here. Venture, private equity, and search, it all depends upon the specifics of the owner of the company as to what's the best solution for each individual founder or owner. And there are great venture capital firms, there are great private equity firms. Likewise, there are firms in some of those industries that don't have great reputations. So first and foremost, I think you want to have a high quality capital partner, regardless of whether you're seeking venture, private equity, or working with a search fund. But to generalize, when you think about venture capital, one of the benefits is you have access to lots of capital. Oftentimes, startups are capital constrained and they need capital to hire people and to scale the business. So the access to capital is important with venture capital investment. They bring specialized expertise and connections, and they might know an engineering hire that you want to make. And so they can be helpful in terms of scaling the business. Sometimes even early stage founders who are taking money or incubating their businesses in venture capitalist offices, right? So they're very involved in the very early stages of these businesses. One of the pros as well is that if you're a founder, you can retain significant ownership in your business. And often that's an important consideration for someone. If you're really looking to swing for the fences and hit it big, venture is obviously an attractive alternative. And so it helps you if you're a first to market mover. Some of the cons that can come with venture is that there are very high growth expectations. As I mentioned earlier, because of the riskiness of their portfolios, they want their portfolio companies to be swinging for the fences. So management has very high growth expectations, which require you to burn a lot of capital and maybe get out over your skis in terms of investments you're making in the business. The company must not get out of the park to achieve the return expectations. Founders often get replaced as the companies scale. You often give up board control, and also venture capitalists, if you're one of their losers in their portfolio, often venture capitalists will stop caring about their losers. And truthfully, whether you're private equity or venture, that's often the same thing. If you're one of the companies that's not doing well in the portfolio, you often don't get attention, nor do you get additional capital. In terms of PE pros, you get a similar access to both equity and debt capital. They use debt more often in PE transactions, so access to capital markets is something that PE buyers often can bring. They do bring expertise and best practices around how to scale your business. And they're often a buyer that's willing to pay market valuations, so you're getting a fair value for the business that you're selling. In terms of cons, PE can feel institutional. It's a very different feeling when you've got PE buying your company and they're sitting on your board, they dominate your board, and you report to them. And so it no longer feels quite as much like a founder-led company as it does like a PE-led company. And PE funds have limited partners and 10-year fund lives, so they're often looking to sell and get liquidity in the 5 to 7 year time frame. So liquidity timeframes are pretty important in the PE industry, and sometimes founders are thinking longer term or have a different profile in terms of the amount of time they'd like to stay involved with the business. Oftentimes, a PE buyer is going to require that a seller rolls between 25 to 50% of their ownership into the new deal. So it's not like you can go out and sell 100% of your business right away. They'll give you a purchase price, and then when you get down to the nitty gritty, what do you know? They say they want you to stay on. They require you to stay on for 3 to 5 years, and you've got to roll half of your proceeds. So you don't actually get full liquidity or even majority liquidity on your ownership position in the business. Other considerations is sometimes you do hear PE as a short-term orientation because they're really trying to improve the business as quickly as possible so that the value of the business goes up, so that when they sell it, they'll achieve the most value that they can achieve. And one other thing about PE is they're very focused on their returns and performance, and they're less concerned about a seller's or a business's legacy and what it means to its other stakeholders. As we shift to search, some of the benefits you get from PE are the same things you get from search. You're getting access to capital and debt. One of the pros about search is that you know who the new CEO is going to be before close. You're actually directly negotiating with that entrepreneur, and you know they're going to be coming in to run the business. So you can assess whether that person's a good fit culturally, and you can assess whether you think they could do a good job running your business. In search deals, sellers can roll and stay involved. So the 2 bites at the apple opportunity is very attractive. I know multiple situations where owners have sold their business to a search entrepreneur and rolled 10 or 20 or 25%. And then 10 years later, when they sell the second time and the business gets sold, they oftentimes make more than they did the first time they sold the majority stake in the business. And so it's a great opportunity for the seller to remain involved in the equity upside of the transaction, especially if they have faith in the entrepreneur and the investor group that are coming in and believe that they're going to do a good job at helping to take the business to the next level. Because often founders have tapped out. They've gotten the business to a certain point, and they feel like a new skill set and a new set of advisors and investors are necessary to get the business to the next level. So that's a really nice benefit for owners. One of the other benefits is that you can mentor a new CEO. You can stay involved if you'd like. There's some flexibility. Maybe you don't want to retire entirely, but you want to get out of the day-to-day grind, and you'd love to stay involved in the business. There are opportunities for owners to do that with search businesses. And that's a positive for people. They often don't want to just hang it up and go to the beach. They know as well with the search fund that they're getting a highly motivated new CEO. They often know the board that will be overseeing the company going forward. They can get to know them as well. And sellers can have more fun and still have a long-term participation in the business if they choose. Some of the cons associated with search that you hear from sellers often is, you don't have a committed fund, and often, there's a worry is, will the searcher be able to actually close on this deal in this company? The great news is that there are hundreds of search fund deals that have been successfully completed, and you can actually talk to the investors. There's tons of capital available, but the structure of a search fund is not to put all the money up front, since the entrepreneur doesn't know what business they're going to buy. And so you can do diligence on that and de-risk that issue if that's something that's important to you. And then also, search fund entrepreneurs don't bring a big team like a PE fund might. It's typically that one searcher and maybe one other person that's kind of parachuting into the business to help in the transition. So it's a heavy lift for the CEO in the first year, and they don't bring the big team that a PE fund might bring. So that's a quick summary, Austin. There's a lot there, but those are some of my thoughts.
Hi, it's Austin, your host, with a brief interruption. Since this podcast is free and not supported by ads, I have a very quick ask for you. If you're finding value in this conversation, please consider sharing it with another leader or aspiring leader who you think would enjoy it, so that we can learn and lead better together. And if you're a software founder considering a successful exit to a partner who will love your team just as much as you do, I would love to hear from you. Please feel free to connect with me on LinkedIn or send me an email at austin@magratheapartners.com. That's austin@magrathea, MAGRATHEA, magratheapartners.com. Thanks, and now back to the show. That was really helpful, and I think also the next two or three questions that I had on my list, you pretty much just effectively addressed, Doug. So no surprise that you're taking these complicated topics and breaking it down into simple, digestible bits for us. But just to play that back to you, it sounds like, if you want to swing for the fences, you want to be a daily operator and like high growth expectations and some pressure don't scare you, maybe venture is a fit for you. If you want to be in the daily operations and you want to take some chips off the table, but not all chips off the table, and you don't mind having a board to report to that brings its own institutional structure and pressures, private equity could be a fit for you, typically above the $25 million in sales mark. And if you're looking for sort of liquidity and also an entrepreneur whose aspiration is to help operate a business, then maybe search is a fit.
That's a good summary. I think that's exactly right. And in terms of types of businesses that you see these various types of investors pursue, Austin, to generalize, venture capital firms pursue startups and early stage businesses. They like to invest in tech, AI, e-commerce, software, hardware, biotech, industries like that. PE is focused on more established, profitable businesses with anywhere from $25 million in revenue to $1 billion plus in revenue across many different types of industries. And in search, you've got specific focus on high quality businesses in the software, business services, and healthcare arenas, as well as some others, often with revenue in the $3 to $25 million range.
That's really helpful. So I'm going to shift into the next section of the conversation here, Doug. For those types of founders who are seeking an exit to an entrepreneur, like a search fund entrepreneur who aspires to help operate moving forward, I'd be curious, how have you seen founders go on and live the rest of their lives with joy? What is it that they do post-sale? Some of them remain involved, some of them don't. Some of them retire to the beach. Others may stay involved in a particular role.
Well, I've seen founders and sellers take so many different paths. Everyone's got their own unique life goals and are thinking about that next chapter in different ways. I've seen a remarkable number of sellers roll some stake in the business and stay involved in some way. And the stories that I've seen there are diverse. I've seen young sellers in their 30s who are technologists who kind of built a nice business but don't want to run and scale the business, sell the company and become CTO and stay on at the business and stay on the board and have a chunk of ownership in the company. I've seen older sellers who have been building a business for 30 years decide that they really like the entrepreneurs and feel like there's an incredible fit in terms of culture with the company they built, and they want this person to kind of carry on their legacy. And they've rolled a stake, stayed on the board, and essentially been kind of a partner to the entrepreneur, and they figure out together where that seller can be most valuable to the business. And I've seen them sellers stay very involved like that. So that's obviously a very appealing thing for many sellers for many different reasons. I've certainly seen sellers say, I'm out. I've been doing this for a long time and grinding, and I want to just do something else. Some sellers will go on and realize that they're great at building a business from 0 to 10 million, but they don't want to go beyond that because it gets really large. It feels like more management that they really want to be involved with, and so they want to go start another business. So I've seen multiple sellers use some of their proceeds and go start another business. I've certainly seen folks who have health-driven sales or life issue-related sales where they've either had serious health issues in the family or a divorce or a death or something which has triggered their desire to sell and to move on to a different stage of life and to get involved with volunteering or hobbies or relaxing and enjoying life. So I've seen people pursue lots of different paths, and I think that it's rewarding to see how many different positive paths people have pursued.
I hear, a diversity of paths. If your aspiration is to, find a partner that is excited to help operate moving forward, then there are a lot of options and paths available if you decide to work with a search fund entrepreneur in their group. So great, Doug. The title of our podcast is the Leadership and Legacy Podcast, and you've just helped us understand sort of paths available to different folks after their own operating career. This brings me back a little bit to you, Doug. You had a very distinguished operating career and decided to become a serial investor. I'd be curious for you personally, Doug, why is it that you continue to spend time with young entrepreneurs, mentoring them, coaching them, investing in them?
Well, for me personally, I just find the process of building a relationship and a partnership with entrepreneurs and helping them in cooperation with their senior teams and with the board to build great businesses. I just find that to be super rewarding work. So many times these entrepreneurs are, the idea in search is that you're buying a good business, but businesses, like anything that's a living organism, it's got chapters. And so, it's really incredible to watch these entrepreneurs take these businesses, which might be 20 employees at close and 5 or 10 million of revenue, and grow them over time and see these companies grow and the entrepreneur grow and watch them bring new jobs to their communities and give people opportunities and promote people and deliver value to customers and stakeholders. So it's really rewarding, and that's why I love doing it.
That's great. And is there a recent story about a moment that brought you joy, kind of from this side of the table, Doug?
So there were a lot of them as I was thinking through this question, and one that specifically stands out is I had a board meeting recently, and in this situation, 2 search entrepreneurs bought a company from a founder, and the founder decided to roll an equity stake and stay involved with the business and remains on the board and continues to work at the company. And we were talking, and it was the 2-year anniversary of these entrepreneurs buying the business. And the founder said at the end of the board call, I just want to say something before we end here, which is, I've been pleasantly surprised by how wonderful it's been to work with these 2 entrepreneurs. I really didn't think I would be here this long, and I didn't think I'd be very energized to stay in the business long term, but I'm loving this experience and loving working with these entrepreneurs, and I've been so pleasantly surprised by the experience. And so that was a very rewarding thing to hear, where the seller was kind of coming clean for the first time that he didn't really expect it to be a positive relationship or something he really enjoyed, and it turned out he's really loved it.
We can all aspire to such healthy and happy partnerships professionally.
True.
And on the topic of professionally, Doug, I'd be curious for you, what is your vision for the next 5 to 10 years at Ravenscourt?
Well, certainly more of the same. As I said earlier, I love partnering with entrepreneurs. I love partnering with investor groups. I love being part of a team that's building great businesses. And by the way, it's not always straight up and to the right. Many times we go through all sorts of challenges, and these entrepreneurs go through all sorts of challenges. But that's part of the fun of being on that journey. And so I'm continuing to really enjoy that work, and I want to continue to do more of it. I probably want to focus on even deepening those relationships and being more present for the entrepreneurs that I work with.
And I, again, count myself as very fortunate to benefit from that intentionality and thoughtfulness with you in my corner, Doug. And Doug, we always close on the topic of legacy. And this is it's a big term and a big concept. I'd be curious, what does legacy look like for you? What does legacy mean to you?
So after I left Asurion, I wasn't sure what I was going to do next. And I was thinking about a lot of different alternatives, and I was reflecting on life. And I really started reflecting on the new age concept of energy, on kind of, how I feel energized when I'm doing certain things, and how I notice my energy gets dissipated when I'm doing other things. And I really decided that I wanted to do the things that give me a lot of energy. And I guess that's the way I think about, my life, and is prioritizing the relationships that matter the most and maximizing, the positive energy that I give out and also get back. And so for me, my family, first and foremost, my wife and my 2 kids are my first legacy priority. And then my friends and my working relationships, my working friendships with entrepreneurs, and helping them to achieve their dreams and having a positive impact upon, all the different stakeholders that are involved in building these great businesses.
I love that. Focusing where you get the most energy, focusing where you get the most energy back, bringing good energy into the world, helping create value along the way, family, business, and maybe a little bit of fly fishing thrown in there too. Amazing. Well, I couldn't imagine a better place to wrap up the conversation today. This was educational for me. It always is every time that I have the chance to speak with you, Doug. Thank you so much for sharing the lessons from your experience with us today and your perspective on the differences, the pros and cons across these various models. I'm excited to get this out into the world. I know that I will not be the only one to learn from this interview. So thank you very much.
Austin, I get great energy from you, and I'm excited about your journey.